morning and a very warm welcome to all of you. My name is Tom Livock from AccessPay. This is AccessPay's 7th episode of a series of webinars talking about finance transformation for corporates. Today's topic is the FX challenges for corporates in 2023, how to prevent currency movements impacting the bottom line. High inflation rates, rising interest rates, as we all know, and geopolitical issues will continue to dominate the foreign exchange market in 2023. FX has emerged as a strategic priority for finance executives around the world. I'm delighted to be joined by Eric Huttman, who's the Chief Executive from MillTechFX.
Thank you, Tom. It's great to be here today, and good morning to all of you, and thank you for joining us. Just to very briefly introduce myself, as Tom said, I run MillTechFX, which is a fintech business that offers what we call FX as a service, enabling best execution. My background, for better or worse, has been entirely in FX. Initially at HSBC, I was a foreign exchange options trader, and then at Millennium Global Investments as a portfolio manager in the discretionary currency overlay team. For a bit of background, MillTech is part of the wider Millennium Global Group, which is one of the largest independent currency managers with roughly $19 billion in assets under management and annual transactional FX volume of around $800 billion. So we at MillTech offer independent, comparative, multi-bank FX execution services designed specifically for corporates, as we call them, end users, so non-speculators with hedging or payment needs, with a specific goal of reducing execution costs and operational burden. So FX has definitely been in focus for many of our clients throughout much of last year and certainly as we start this year as well. So very pleased to be with you today and to share some thoughts on how to tackle some of these challenges that FX can pose.
Thanks, Eric. And we really need your expertise to address some of these challenges we're going to talk through today. So just before we get started, a couple of housekeeping points. Firstly, we're going to spend maybe about next 20 minutes or so talking through these FX challenges, and we aim to finish around about 11 a.m. The session is being recorded, and the link will be available afterwards if anybody wants to replay or rewatch any of the webinar. If you have any questions, please use the chat box, which is on the right-hand side, and we'll do our best. Between Eric and I, we'll do our best to answer those questions as we go. So without further ado, let's get started. First question, Eric, is really, what does a good FX setup look like? There's lots of FX companies around, and how does a business decide? How does a corporate decide what is right for them?
So look, I think the first thing to note here is that there isn't necessarily some kind of one-size-fits-all panacea, but there are a few, I think, guiding principles that I think are worth bearing in mind. First of all, I think deciding what you're solving for as a business, as a corporate within FX, i.e. creating an FX policy is I think a natural starting point that's required before you even consider like what your FX setup should look like. So what that means really is defining your risk tolerances, what your position of least regret might be. And there's a hint here, doing nothing in FX is actually an active decision and isn't necessarily a neutral starting point, which is maybe a little different in FX land versus in other walks of life. Doing nothing is actually an active decision. Anyhow, so once you've done that, i.e. created that FX policy, a good, in inverted commas, FX setup should be one that addresses your problems. And now, whilst every situation is unique, we did a pretty comprehensive corporate FX survey recently. And if we look at the slide that we have with 3 charts, we'll see some of the key problems that we found many people are facing, chief among which is that achieving this elusive thing called best execution is both difficult and important, along with getting comparative quotes, as you can see in both the first and second charts there on the slide. And so to use, if we sort of bring this out of FX land, if we use a travel analogy, people don't want to be beholden to just flying EasyJet, right? They want to be able to get prices and maybe even fly on BA or Ryanair.
Or Ryanair, right? Yeah.
right? And not that I'm endorsing any of these three airlines, but it's just a metaphor, right? So if we bring that back to FX, then a good FX setup really should be one that enables easy, streamlined access to multi-bank quotes, i.e. not have you just beholden to your house bank, but get prices from multiple places so you can get best execution, whilst also automating manual processes. Right, and these problems that we've highlighted here in our survey on the charts kind of indicate and actually really were guiding principles as to why we created MillTech in the first place. Because unless you're a mega corporate, these can be quite hard to do by yourselves. But so, as I say, there isn't one size fits all for a good FX setup, but having something which reduces manual burdens, automates processes, and gives you multi-bank best execution, I think is a good starting point.
So from the chart on the left-hand side, getting comparative quotes, demonstrating best execution, and the manual process, I think I can get my head around what that means. The fourth one, which is at 33%, 33.07%. So that's a third, effectively. Onboarding liquidity providers. What's the onboarding process look like?
So if we think about the setup for, let's assume that all liquidity providers are banks for a minute, and that's not necessarily true, but in general
Sure.
it is. If you want to get set up for especially hedging, that means that you're trading instruments that are derivatives. So normally it's FX forwards, swaps, non-deliverable forwards if it's emerging markets. And in order to onboard with a bank or liquidity provider, you normally need to have what's called an ISDA in place, an ISDA agreement, an International Swap and Derivative Association agreement that governs your derivatives. And basically creating and setting up these ISDA agreements for what is essentially a second order requirement for you as a corporate is basically an enormous pain. It's very cumbersome. It's a highly legally complex set of documents. It takes an awful amount of time for both you and the banks. And so it can be, when we say onboarding liquidity providers, it specifically means creating the necessary legal framework in order to have a trading relationship on a bilateral basis. Basically takes ages and it's a massive pain.
What would MillTech's involvement be in creating that ISDA agreement?
So the difference with someone like us, and we, for good order's sake, we're not a bank, we're not a broker, we're not a market maker. We're an access point to the wholesale market, if you will. And as a result, what we have in place are what are called agency ISDA agreements. So they're ISDA agreements in our name as agent. So we own the documents and all the negotiation, and we can onboard a client under those agency ISDAs for them to face the banks from a credit perspective, but under our terms. So we remove a lot of the negotiation headache and even some of the KYC AML burden because clients sit under our pre-agreed, pre-negotiated agency agreements.
Understood. So does that mean a corporate wouldn't necessarily need, they would still need an ISDA agreement, but the amount of effort it takes to get the ISDA agreement in place is a lot less if they're working with MillTech?
Yeah, it would mean that they wouldn't need their own ISDA. So they would still sit under an ISDA. It would just so happen to be our ISDA that we own as agent. And it means that a lot of the operational headache that goes into negotiating one from scratch disappears.
Understood.
So it's a big operational cost saving.
So that comes on to the next question, which leads nicely into that. And this wasn't planned, by the way. It's just the way the conversation has gone. So the next question was really around changing your FX setup. I can imagine that's a significant amount of work if a corporate's wanting to change who their provider is. So how would you quantify if it's worthwhile doing that?
Yeah, look, I think you're right. And basically changing any kind of ingrained process can be a nuisance. Right, and let's face it, FX is a byproduct of doing business for corporates. It's somewhat of an ugly duckling that starts to quack when things go wrong. Right, I have yet to meet a treasurer who says, "Yes, I'm so thrilled that I've got FX risk to manage." Right, it's basically always a pain. And so, really changing your FX setup should ideally do one or both of the following: it should reduce costs, and it should reduce operational burden and risk. Ideally both, but at least one of the two. And so the first step in assessing something like cost reduction potential is actually transparency. Get your data, right? And so you should have access to proper, fully time-stamped execution history. And if you don't, that's an indication potentially of something that might want to be looked at. But let's assume you have that. From there, you can use something called transaction cost analysis, or TCA as it's called, which in effect is an audit on the quality of execution. Right? Think of them like Deloitte, who does an audit of your financials. There are companies, independent companies, that audit the quality of your execution using independent mid-markets at the point in time that you traded, compares that to where you traded, and you get an actual cost in basis points and in dollars or in pounds. And you can then use that to make an apples to apples comparison with any new provider. Right. So that's how do you quantify whether it's worthwhile from a cost perspective. And the second part, from an operational efficiency perspective, it can be slightly more nebulous, but one of the ways that that our clients have done it is to look at actually the time that they spend doing FX. And based on our data, we've seen clients spend around 90% less per month on their FX when they use us versus before. So that can be obviously very meaningful. So those are the two areas I'd say can quantify whether it's worthwhile.
Yeah, and so in your experience in a treasury team, the 90% would equate to, obviously it depends on the organization, so it's difficult to say, well, that equates to this amount of full-time equivalent person. But in your experience, if for let's say there are a mid-sized corporate, maybe between a billion turnover and maybe 2 billion turnover, how many FTE saving would that equate to?
So I don't have necessarily the FTE data, but what I can tell you is based on just hours, and this is based on client feedback on telling us how long they spent doing their FX before us, and then looking at actual empirical data as to how long people spend on our platform. So the rough estimate that people give us is that they were spending around half a day a month.
Wow.
Sometimes more, sometimes less, but around half a day a month doing FX. And that's around doing the execution, doing the payments associated with it, doing any reconciliations that are necessary, around half a day a month doing their FX. Versus with us, on average, clients spend around 18 minutes a month on our platform.
Right. So you combine that with the
94%, if you will, time saving. So that's how we look at it. It's not perfect and won't apply to everyone, but that's our experience.
No, that's a useful metric. Thank you. So combine that with the reduction in the costs and the operational efficiency, there's some significant benefit, let alone the other stuff we're about to come on to. Just on those 2 points alone, there was a significant benefit in an organization thinking about what their current FX system looks like and how it could be improved.
Yeah, agreed. And as I say, if those two things might not be equally weighted in people's minds. They might say, actually, you know what? Okay, cost is important, but my real problem is I'm scaling. This is taking way too long, and this is a massive pain. I've got to improve my operational efficiency. Whereas someone else might say, actually, I don't really care about time. This is purely a cost-saving thing. The beauty about it is there are ways of assessing both of them.
Great. Okay, so let's move on to the next topic, which is environmental, social, and governance. So ESG really has become a buzzword maybe in the past couple of years, and ESG enhancements are really seen as a priority for most businesses in 2023. Any new systems are likely to need to fit into an ESG criteria, but how can an FX platform improve an organization's ESG credentials?
So look, I think you're right. I think it's definitely a buzzword, but I think really for many businesses, ourselves included, it does actually genuinely matter. It's not just a box tick. It matters both for stakeholders in a business, shareholders in a business, but also I think it matters for the employees of a business. And it's certainly something that we see when we hire. But anyhow, I think there's a lot of effort that's been done in the E and the S within ESG. Rightly so. But I think that arguably it's in the G, the governance element, where there can be a lot of improvement in FX especially. And if we look at the history of FX, it hasn't screamed strong governance. there have been a lot of, let's say, not great practices that have happened in the past 20, 30 years in FX. And it hasn't had a great name from a strong governance standpoint. That has thankfully changed and is continuing to change. But as we talked about earlier, the concept of multi-bank best execution with costs evidenced by independent third-party TCA, transaction cost analysis, is central to strong governance, I would argue, within FX. And so using a partner or a platform that demonstrates this or enables you to demonstrate it is therefore essential. But I think one step beyond that, and this has nothing to do with a platform necessarily, but I would argue that, or I would encourage people to look at something called the FX Global Code and hopefully become signatories to it. The FX Global Code is a set of principles. It's not regulation and it's not a rule, but it's a set of principles of good practice designed to promote integrity and the effective functioning of the FX market. In fact, one of my board members actually helped write it with the Bank of England. But corporates and buy-side firms in general are, first of all, not terribly aware of its existence, and indeed make up a very small minority of signatories. So I'd encourage more people to have a read of it and sort of embody some of those principles and then hopefully sign up to it as a strong pillar of governance within the FX industry.
And Eric, the FX Global Code and those principles, are they available on the internet? So if I Googled it, where would I find them? Where would I get them?
Yeah, absolutely. So if you look up globalfxc.org, you'll find it. And you can see on there, there have been several iterations of the Global Code. It'll give you it'll give you assistance on how to adopt it. There's a whole website on that.
Great. So that was globalfxc.org was the place to find those principles.
Correct.
Great. Okay. So let's move on to the next topic, which is about an outsourced FX service. So I'm a corporate treasurer. I've got my own FX function in my treasury team. And for whatever reason, we decide to go to market and we're looking to outsource that FX service that we need. Doesn't that jeopardize the role of my treasury team and my FX lead within the treasury team?
So I'd argue that a good one should do the exact opposite. A bad one might not, but a good one should do the opposite. And I also, incidentally, I tend to find that people are more comfortable with the phrase managed service than outsourced provider. But anyhow,
right,
that's a different story, even if it does the same thing. But joking aside, what we found at least, and I can only talk from my experience, with our clients, is that typically FX is a source of frustration for them, not a source of value add within a treasury team.
Right.
And it's definitely not their primary function.
Yeah.
If I think about the treasury team, it normally has a function of using and moving money, with FX being a relatively ancillary function of those two core things. So this isn't about outsourcing the entire treasury function. This is about removing potential sources of pain and operational risk for something which they don't actually want to be doing if they didn't have to. So subject to fulfilling certain criteria, outsourcing FX primarily gives the team back time, I would argue, to focus on more important things, whilst at the same time giving them full visibility and transparency over their data. And so if we look at the slide that we have with a single bar chart, we can see the kind of things that people are concerned about, and frankly, rightly so. Right, the number one concern that people have here is around trust. Right, the second one is onboarding. Hey, we talked about onboarding earlier. Any kind of onboarding's generally a nuisance. There's also concern about costs, because in a normal, or I'd say outside of FX, typically when you're outsourcing something, it involves higher costs. And the other element here, which is important, is a lack of control. But so if I come back to trust, though, trust is such a key element here. And it also goes back to our point on governance a minute ago, right? With governance comes trust. You don't get trust automatically with governance, but I would argue that strong governance is a necessary ingredient to trust. But ultimately, retained oversight and control are key ingredients, I would argue, in empowering a treasury team when they choose to outsource a specific function like FX.
Yeah, that's great. And going back to the point you made right at the start of this session, where you mentioned about an FX policy and making sure that the organization has a well-defined FX policy, assuming that outsourced provider is able to match that policy that's been put into place by the Treasury team in the first place, then actually should be a real positive, right? This should be as you say, rather than being an ancillary function, it allows the Treasury team to focus on the things that they're actually need to process as a function.
Yeah, agreed. And I would say that the starting point, as we mentioned earlier, is define the problem and then create a solution which solves that problem and have metrics that can help you keep control and oversight that you are indeed solving the right problem, not that you're solving a different problem that the outsourced provider says is the one that you should be focusing on. No, define your own problem. And I think that, and I think the other element is you don't have to outsource everything, even within FX, right? There's sometimes, I would argue, sometimes people think of outsourcing as binary, whereas I think what we found is that if you're able to split functions or problems out into distinct verticals, you can then decide which and how of those underlying verticals you can outsource. So having a flexible outsourced solution or managed service, I think, is integral to that.
And in your experience, if a corporate was looking to outsource and they hadn't done this before, and it was the first step that they were going to make, so it was like you said, it's toe in the water time. Which of those functions or which type of FX transactions are we going to outsource? What would your recommendations? What would your advice be for that?
So I think the starting point is figure out where there's pain. And what we find with our clients is the typical pain comes in getting access to a bunch of different extra price providers. So that comes back to the best execution piece. And it's around figuring out, okay, I might have hedging to do. I might not necessarily know when to hedge, how to hedge, which instruments to hedge, which tenor, which length of instrument to use to hedge. And I don't necessarily know my costs associated to it. And so starting with those things and having an outsourced partner that can, in effect, automate all of that whilst plugging into your, for example, treasury management systems or your banking platform, I think is the important first place to start.
Thanks, Eric. So looking towards 2023 and maybe even 2024, what is the outlook for the short, medium term?
So look, I think if we're sitting in January at the moment, FX volatility is high. It's been high, arguably, for some time now. And really the macro environment in which we find ourselves is likely to lead to continued elevated levels of, frankly, broader macro volatility, but especially in FX. And I think if we think about the macro environment, the market is starting to price in the potential. We've talked about earlier interest rate hikes. The market's actually already pricing in the potential for interest rate cuts later in the year and early into next year as recession probabilities increase and as the effect of monetary tightening starts to filter down into the real economy. So ultimately what this means is uncertainty is likely to continue in my view. And as a result, what we've seen, and what does that mean for a treasurer in FX? What we've seen is an increase in desire for corporates to want to understand and mitigate their FX exposure. Why? Because in the context of this macro, elevated macro risk, there's increased variability and uncertainty on their top lines, on their revenues.
Sure.
Right. And so given that uncertainty, the extra level of uncertainty coming from FX is something that actually they can get a handle on. Not necessarily immediately, and there's going to be some effort there, but they can do it. And so what we found in, for example, the survey that we did that we mentioned earlier, is that almost 90% of respondents who did not have a formal hedging policy in place were now considering adopting one, primarily in light of the elevated volatility environment. So, likely this is going to be a challenging 2023, but I think there is some pretty clear ways that those challenges can be tackled and addressed.
Thanks, Eric. So you mentioned the white paper, the research that you carried out. Is that available freely? Can I get it if I went to your website? Can I get it from your website? Where could I get that from?
Yes, absolutely. It's available on our website. You can download it there. It's called the MillTechFX CFO FX Survey, the Intensifying FX Challenges for Corporates. It's a roughly 15-page document, so it won't take you a while to read, and it's mostly graphics. So by all means, hop onto our website and you'll be able to find it there.
Great, thanks, Eric. We're getting close to time, but we've just got one question that's come in from the audience, and it's to do with that changing. If we're talking about changing the infrastructure, like we mentioned a few minutes ago, what's a typical time frame for changing? If a treasury has an existing infrastructure and they're looking to outsource that, maybe what's the typical time frame for that?
So the short answer is it depends on how motivated you are to get it done. It can be as quick as, frankly, we've seen, can be as quick as a couple of weeks, given the umbrella processes, umbrella ISDAs that we have in place, for example. But in general, we find onboarding takes about a month. Okay. As I say, it can be quicker if a client is efficient at providing the fun required KYC AML information, because we're all regulated businesses here in FX. We are, our banks are, and so there is a burden that is required from a know your customer and anti-money laundering perspective. But if that information is provided and collected in the right way, onboarding doesn't have to be as much of a pain as it might seem. As I say, on average, roughly a month, but we've seen it in as quick as a couple of weeks.
Great. That's better than I expected. Actually, I thought you were going to say something like 12 weeks, depending on who's the provider. And
that, look, we've seen that, and that can happen, but it doesn't have to be the case.
Great. Okay. Just one more question, actually. So the outsourcing business processes. So we talked about outsourcing this. Surely it poses a risk to data. Mm-hmm. And how can a corporate make sure that their sensitive data is secure? Is that even possible?
Yeah, and I would argue that it's not just outsourcing, but it's any kind of tech integration really poses a risk to data. And we live in such an interconnected world that I think data security, it goes to the heart of any business today. It should do. I would say, though, that ensuring that sensitive data is secure is not just possible, but I'd argue a necessity. You can never guarantee 100% security, but I think there are certain things which you can do which can help mitigate it to the largest extent possible. If I think about cybersecurity risks, which, as I say, are a threat to all of us, imagine, like us, if you're a highly visible tech platform that handles billions in dollars a month of FX flow, how attractive do you look to Mr. Hacker? It's something that we take very, very seriously. And as a corporate using any kind of tech partner, I'd encourage you to get some info on their cyber and information security. Get their policy documents. Ask if they are ISO 27001 certified or SOC 2 if they're more US focused. And ask when they did their last penetration test. If they say, what's a penetration test, run for the hills.
Okay, that's really sound advice. Thanks, Eric. And we're close to time now, so I'll just like to say thank you for everybody for joining this session. Eric, thank you for your advice and your recommendations. It's been extremely insightful, and I hope that we've addressed some of those challenges that we posed right at the start of this session. So thank you for your time and those questions that we've hopefully just answered, and we look forward very much to seeing you very, very soon.
Thank you, Tom, and thank you, everyone.
Cheers. Bye for now.